How do fix and flip loans work for beginners? Well, I can tell you when I started real estate investing over 25 years ago, that makes me sound really old. I guess I am getting some gray hair though. You couldn't, because lenders didn't want to lend to people unless they had a proven track record of doing deals. You see, they didn't want to take the risk on with that. As a matter of fact, there weren't hard money lenders, private money lenders like there are today. They were there, but it was nothing like we're talking about today. Now there's more and more lenders that are willing to do things for first-time buyers. There's more and more lenders willing to do things for first-time investors. However, lots of them are price prohibitive unless you've got some of that experience. So very few lenders will lend to you if you don't have the experience and you're new. And that's exactly what we strive to provide for, is helping new people get started in the business. So how does it work? Okay. It really is going to come down to a few things. Number one, loan to value. Okay. And we're talking about after repaired value, ARV. What is the loan to value? The lower the loan to value on the after repaired value, the greater chance you're going to have of getting a deal funded. That's just all there is to it, because the lower that is, the less risk that there is. And so after repaired value is the value of the home once it's fixed up. The house is worth whatever. Let's say the house is worth $200,000. Okay. So loan to value, if the lender's lending $100,000, they're lending 50% of loan to after repaired value. Now, that's not how typical banks work. Typical banks are going to do as is value, what it's worth right now, because this property isn't worth the $200,000. It's probably worth $100,000, maybe $120,000. But once we spend $50,000 of work into it, then it's going to be worth $200,000 because there's the value add to that. Okay. So that's the first thing you got to realize, is a bank is going to do as is value, not after repaired value. And it's going to cost money to get us there. So loan to value, the lower this loan to value, the greater loan to after repaired value, the greater chance you're going to have of getting that funded. The next thing you're going to have to look at is the rehab, this $50,000, because when it comes down to it, there's three major decisions you have to make as a new investor. Number one, you have to say, who's going to fund my deal? Number two, you've got to determine value. And then number three, you've got to determine rehab and contractor. Okay. Get these right, and your success rate goes up drastically. Okay, so let's talk. We've talked a little bit about the loan to value, which comes in here with the value. Now with the value, with this coming in and being worth $200,000, this is a guess. It's an educated guess using current day comparables as to what the future value of the property is worth. So the sooner we actually get the rehab done and get it back on the market and sold, the better chance we're going to have that this value is accurate, because things can change from the time we estimate to the time that it actually happens, for the good or for the bad. So what we're doing with this is trying to facilitate it happening as fast as possible so that we can get as close as possible to that price, which in the shortest amount of time, there's the least volatility that's going to be happening to that. Find the right comparables and then validating that with an appraisal and a desktop value to make sure you're there. That's going to be big. Next is your rehab and contractors. So one of the big things you have to realize with your contractor, they have to have experience doing the exact job that you have done. You have to make sure that you have a contractor that's licensed and insured. But well beyond that, you want to make sure that contractor has recently done the type of work that you need done. So if you go find a contractor who's licensed and insured, and he's been doing $10,000 to $20,000 fix-ups, and he's going to come and do a $50,000? No way. You don't want to do that. You want to find somebody who's doing $50,000 to $75,000 fix-ups regularly in the last year, and then use someone like that, because the guy that is doing these does not have the experience to do the type of renovation we're talking about, and you don't want to be the guinea pig. You pick the wrong person, your entire model blows up, because the prices could be wrong on the rehab, the quality of workmanship can be wrong on the rehab. So vetting your contract contractor is essential to making sure that this deal happens and happens correctly as a brand new real estate investors. But the most important thing that I left for last, best for last, is funding the deal. The very best thing you can do as a new investor is reverse engineer your success. So rather than going out there and finding deals, you want to go and find a hard money lender that will do deals for you if they're the right deals. But instead of just finding them and then going and finding deals, you want to find that lender and find out what are they best at doing? What is their sweet spot on that golf stroke? Where is the sweet spot that they love to do deals? And so you can just ask them, hey, what are your favorite types of deals to lend on? What are your very favorites, the ones that you guys get up and down and jump up and down and celebrate if you're able to lend on? What do those look like? Okay, what areas are they in? What price range are those in? How many bedrooms and bathrooms are those? What's the size of the acreage? Those types of things. And then I use that as a shopping list as a new investor to go find those properties so I can come back to the lender, the hard money lender, with exactly what I want. I know the values are correct because I've done my correct comparables and I've looked at the heat maps. And I know I've selected the right contractor that has experience in doing this. That is how rehab loans work for new investors to be successful.